Today I will be giving you a basic introduction to RSI, what it is, and how to use it in your day-to-day trading. What is the RSI? The Relative Strength Index, in other words the RSI, developed by J. Wallace Wilder, is a momentum oscillator that measures the speed and change of price movements. The RSI oscillates between 0 and 100. Normally the RSI is considered overbought when it trades above the 70 and oversold when it trades below the 30. The picture you see in front of you is what a normal RSI will look like when you add it to your trading charts. There are two levels representing the overbought area and the oversold area, which is the 70 and the 30. When price reaches these levels, it tends to start looking for a turnaround to the different direction. Let's jump to the live charts real quick so I can show you how to set up your RSI. On your trading platform, you'll see there's a button at the top of your tool tab called Indicator List. You click on that, go to Oscillators, Relative Strength Index. This pop-up box will allow you to change all your settings for your RSI indicator. Standard period, which is 14. Go to the Levels tab. No levels added into my RSI indicator yet. By default, the RSI is already set with a 100 level and a 0 level, so we just need to add everything in between, all the way up from 10 to 90. To add levels, you just click on the Add button. After that, you just click OK. Then your RSI will pop up at the bottom of your chart. How does the RSI work? In an uptrend, the RSI tends to remain in the 40 to 90 range, with the 40 and 50 zone acting as support. During a downtrend, the RSI tends to stay between the 10 and the 60 range, with the 50 and the 60 zone acting as resistance. These ranges will vary depending on the RSI settings and the strength of the market's underlying trend. How to calculate the RSI? The average gain or loss used in the calculation is the average percentage gain or loss during a look-back period. The formula uses a positive value for the average loss. The standard is to use 14 periods to calculate the initial RSI value. For example, imagine the market closes higher 7 out of the past 14 days with an average gain of 1%. The remaining 7 days all closed lower with an average loss of minus 0.8%. The calculation for the first part of the RSI will look like the following expanded calculation. The RSI oscillator is one of the best indicators when it comes to spotting divergence in the market. If the underlying price makes a new high or low that isn't confirmed by the RSI, this divergence can signal a price reversal. If the RSI makes a lower high, then follows with a downside move below a previous low, a top swing failure has occurred. If the RSI makes a higher low and then follows with an upside move above a previous high, a bottom swing failure has occurred. On the charts in front of you will see two perfect examples of divergence. While price was still in a downtrend, the RSI was already busy trading its way to the upside. Price was making lower lows, while the RSI was making higher lows. This resulted in an immediate change in trend, back to the upside. While price was still in an uptrend, the RSI was already busy trading its way to the bottom. Price was making higher highs, while the RSI was making lower highs. Right after this, we got a downtrend. Like all other indicators, there are some limitations when it comes to the RSI. The RSI compares bullish and bearish price momentum and displays the results in an oscillator that can be placed beneath a price chart. Like most technical indicators, its signals are most reliable when being used with a longer-term trend. Since the indicator displays momentum, it can stay overbought or oversold for a long time when an asset has significant momentum in either direction. Therefore, the RSI is most useful in an oscillating market where the asset price is alternating between bullish and bearish movements. Useful tools to go with the RSI. As the name implies, RSI is simply measuring relative strength of the underlying market. When using the RSI to identify reversals, it is important to incorporate other tools like candlestick analysis or trendline analysis. For example, if you find a reversal candlestick near a trendline where the RSI is diverging, then you have a trading signal being generated. What markets can the RSI be applied to? Since RSI measures the relative strength of the underlying market, it is a technical tool that can be applied to nearly any market out there. However, it is commonly applied to the more liquid and larger markets like Forex, stocks, and commodities.